Hello students, good morning everybody. Welcome back to session in Managerial Economics subject. Here we are at Unit 5 and the name of the unit is Microeconomic Analysis. In this unit, we are going to discuss about the topic so-called national income concepts. Let us see what is meant by national income. The income of all the people in a country is called national income. In other words to say, if we add all the incomes received by all the citizens in an economy, it is referred to as national income. National income means the aggregate income of the nation. It is the net value of total goods and services produced in a country during a particular year. Here we have to use the term net value because we need to deduct the depreciation of capital assets involved in the production process. While counting the value of goods and services, we have to count only the value of final goods and services. In order to avoid double counting, no item should be counted more than once. Well, let us see various definitions of national income given by different authors. Here we are with Alfred Marshall definition of national income. As a first definition, the labor and capital of a country acting upon its natural resources produce annually a certain net aggregate of commodities, material and immaterial, including services of all kinds. The limiting word net is needed to provide for using up of raw and half-finished commodities and for wearing out depreciation of plant which is involved in production. In all such waste must of course be deducted from the gross produce before the true or net income can be found, and net income due on account of foreign investments must be added in. This is the true net annual income or revenue of the country or the national dividend, and this definition was given by Alfred Marshall. Let us go with definition 2. The national dividend is that part of the objective of the income of the community, including of course income derived from abroad which can be measured in money. This is the definition given by Pigot. And next definition, the national dividend or income consists solely of services as received by the ultimate consumers, whether from their material or from the human environment. And this definition of national income was given by Fisher. Now we are going to deal with national income concepts. The following are the important concepts of national income. Here we can notice gross domestic product indicated by GDP, gross national product indicated by GNP, net domestic product NDP, net national product NNP, and in this NNP at market prices and NNP at factor cost, personal income, disposable personal income, per capita income. Let us see the national income concepts, and under this we are dealing with gross domestic product, GDP. Gross domestic product is the total value of all the final goods and services produced domestically in a country during a particular year. The value of these goods and services measured in terms of money. Here only final value of goods and services has to be taken into account. Only domestically traded goods and services have to be counted under GDP. International transactions has to be avoided. Here we have a formula for GDP. GDP equal to C plus I plus G. Here GDP stands for gross domestic product, C stands for consumption expenditure, I equal to investment expenditure, G equal to government expenditure. Next, gross national product, GNP. GNP is the total value of goods and services produced by the people of a country in a year. In addition to the consumption expenditure, that is C, investment expenditure I, and government expenditure G, here GNP includes net balance of trade, that is exports minus imports. See, when we see the formula of GNP, gross national product, GNP equal to C plus I plus G plus X minus M. Here GNP stands for gross national product, C stands for consumption expenditure, I investment expenditure, G government expenditure, X minus M equal to net foreign income. Next one, net domestic product. Capital assets generally wear out in the course of their usage. So year by year, the value of capital assets depreciates. Therefore, this depreciation of wear and tear out of using the assets generally has to be estimated. Then it has to be, in essence here, the depreciation has to be deducted from the gross domestic product in order to get net domestic product. Hence, we can say NDP equal to GDP minus depreciation. Next one, next concept, net national product NNP. Here we study this NNP at under two heads, NNP at factor cost, NNP at market price. NNP at factor cost is the sum of rent, wages, interest and profits paid to factors for their contribution to the production of goods and services in a year. NNP at factor cost equal to NNP at market price minus indirect taxes plus subsidies. Next one, personal income. Personal income refers to an individual's total earnings from wages, investment, enterprises and other ventures. Personal income is denoted by PI, where personal income is the sum total of all incomes actually received by all the individuals or household during a given particular time period. In other words to say, personal income is the income which is actually received by all the individuals or households in a country during the year from all the sources. Personal income is the total money income received by individuals and households of a country from all the possible sources before direct taxes. Personal income is expressed as follows. Here personal income equal to NI minus corporate taxes minus undistributed profits minus social security contributions plus transfer payments. Next one is disposable income. The income left after the payment of direct taxes from personal income is called disposable income. Personal income is not totally available for spending. Income tax is a payment which must be deducted to obtain disposable income. Disposable income means the actual income which can be spent on consumption by individuals and families. Disposable income is expressed as follows. DI equal to personal income, that is PI minus direct taxes. Next concept we study is per capita income, PCI. Per capita income refers to the measure of amount of money that is being earned per person in a certain area. Income, here per capita income can apply to the average per person income for a city, region or a country, and is used as a means of evaluating the living conditions and quality of life in different areas. In simple to say, nation's income when divided by nation's population, we obtain per capita income. Per capita income is a useful economic indicator for an area. Basically, per capita income PCI is how much income each individual of a population would receive if the area's total income is divided equally among all the members of population. Per capita income is a measure of wealth of the population of a particular nation, especially when compared with other nations. Per capita income is expressed as follows: PCI equal to I by P, where here PCI stands for per capita income, I stands for personal income, that is total personal income, P equal to total population. Thank you.